Hey, it's Kristi, and I want to help you get ready to buy your home in 20 minutes or less. Are you ready? Let's do this. So very first step that we should work on is getting your credit established and clean. So I want you to go to annualcreditreport.com and pull your free credit report. It's not a hard inquiry for you to do this. It's going to give you the tri-merge, which means all three credit reporting bureaus, and you are not paying for the credit scores. They use something that's called a Vantage credit score, and that's not what we use when we pull for the purpose of a mortgage. So don't even worry about that right now. Ultimately, we do want to worry about where your credit scores are at, but right now all we're doing is making sure that the credit information is being reported accurately. If there are addresses that you've never lived at, clean that up. If there are misspells on your name, you can clean that up. What you'll do is you'll address all three credit reporting bureaus and create a dispute and tell them what is inaccurate on your report. You're also going to look for collections, derogatory accounts, late payments, anything like that. And if it's not truly yours, you need to dispute it off. Again, same way, you're going to go to all three credit reporting bureaus directly and dispute that information. If it is accurate information, simply disputing it does not make that go away. That creditor is going to be charged with having to prove that that information is correct. And then once they do, it shows back up on your credit report again. So it's just a temporary band-aid. It won't make it go away. Now, if they can't prove that that information is valid, then they can make it go away. But if you know that you've made late payments, just know that 35% of your credit score is made up of your payment history. It is so important to pay those things that report on your credit. So that's going to be things like credit cards, auto loans, those kinds of things. What's really essential about that is that's part of the system that the underwriter, which is the decision maker for the lender, is going to use in the overall profile of your ability to borrow money and pay it back on time. They're basically making a judgment on your attitude towards money, your behaviors towards money, and if you can pay back those little things, there's a really great chance you're going to be paying back the big things on time too, which is most important to them. So very first thing, clean up your credit. If you don't have really deep credit, that's okay, but go to somebody in your life and ask if you can be an authorized user on one of their credit cards. What we're looking for is somebody who has a long-standing relationship with a credit card company, and I would love for it to be a bank, not necessarily a store credit card. So Discover, Capital One, Chase, something along those lines, and you're looking for years worth of history, a high limit, but a low balance. If they've got that credit card maxed out, that's really not going to help you. So find somebody in your life that has that. Ask if you could become an authorized user. The important part is it's not debt that's held against you because you're not responsible for that payment. You're not an owner of that account. You're just a user. And also there's no hard inquiry into your credit because you want to avoid that while you're preparing to buy a home. The next thing that's really important about this is if they have 5 years worth of history with that credit card, that 5 years worth of history gets added to your credit profile now, even if you're 18 years old. So it's really significant to start there. Okay, so I'm not a big fan of adding new debt, but you really do want to have at least one revolving trade line, which is a credit card, and it can be that authorized user account, and at least one trade line that is an installment loan. So that a couple of examples: auto loan, student loans, your mortgage will be an installment loan. I don't want you to go out and take on new debt if you don't have to. If you're not in the position where you're going to finance your car or finance your education, then please don't go and take on new debt. What you can do is find like a credit builder account, and what that does, it's usually through a local community bank. They'll report to the credit reporting bureaus that it's an installment loan, but really all it's doing is taking money out of your checking account, putting it over here into a savings account, and they report it as if it's an installment payment. If you don't want to go that way, Experian Boost will allow you to report anything that's in your name. So if you have utilities, cell phone bill, those kinds of things, it will show it as an installment loan payment, even though it's not really an installment loan. So that will help with that one credit reporting bureau. So that's only with Experian. That won't go over to TransUnion or to Equifax. There are ways that you can report your rent as an installment loan payment. You have to pay for this service, but you can actually just Google that term and you can see how you can get that reported. I would only recommend that if you need to have additional trade lines showing up on your credit report because you have very thin or no credit to start off with. It's really important to show and demonstrate the ability to borrow money and pay it back on time. And if you have credit card balances, this is where I need to tell you, get those balances below 30% of your limit. It's really important. It will have a huge impact, positive impact on your credit score, and it also shows your ability to borrow money and pay it back on time without overutilizing or overusing what is available to you. If you max out that credit card, it doesn't actually reflect well on your credit history, and it shows that you might be in a position where you're overspending versus what you are earning. So we don't want to look that way on paper. So now let's talk about your savings. Depending on the loan program will depend what the down payment requirement is, but there's two parts that make up your cash to close. There's your down payment requirement on that mortgage loan, and then also your cost of doing business. We call it your closing costs. If you've bought a car, you also have paid closing costs. You've paid tax, tag, title, dealer fee. That's along the same lines. So everybody gets their hands in it when you are buying your home. So depending on where you live and what loan program will depend your closing costs, but it's a really nice rule of thumb to count on about 3% of your purchase price in the form of closing costs. So if you're buying a $200,000 home, let's assume $6,000 are going towards your closing costs. Now, there are down payment assistance programs out there, but I don't want to rely on that if we don't have to. More times than not, I see where somebody doesn't qualify for the down payment assistance program. And it's either because of having lower than the required credit score, or you earn too much. Those down payment assistance programs are really designed for those households that truly cannot save a dime just because they're paying every dime just to getting by because they're below, it's usually 80% of the median income for that area. So if you make a decent income, let's just presume that we're going to come up with a down payment. So now it depends on the loan. If you are a veteran, you may be eligible for a VA loan, and that means you've got 100% financing coming your way. Now there's still closing costs to contend with, but you don't have to have a down payment. Also, there is a program called USDA, and that is geographically based, and it's for rural areas, so not all areas will qualify for this. And there's also some income caps attached to that, but those are the two 100% financing options. Outside of that, a conventional mortgage requires 3% down if you've never owned a home or you haven't owned in the last 3 years. If you have some derogatory things that are showing up on your credit, like some late payments, maybe you had a car repossession in the past, or you've got some open collections, then FHA might be the way for you to go, and that's going to require a 3.5% down payment. A lot of first-time home buyers wind up with an FHA loan, and it's extraordinary because it lets you go a little bit higher on the debt-to-income ratio, which I'll explain that in just a moment, and it also allows for some collections to be open or part of the past with late payments, those kinds of things, without always having to have that completely cleaned up. Now, your down payment has to be something we can paper trail and that we can prove. So if it's coming out of your savings account or your checking account, it actually needs to be in the bank. If you have mattress money and a couple $1,000s sitting in a safe, if we can't prove where that came from, which you can't prove cash, we can't use it. So if you're a couple months away from getting the process started, start infusing that money into your bank account so that we can use it as part of your down payment and your closing costs. One thing I want to make sure you know is unsecured funds cannot be used for your down payment or for your closing costs. So what does that mean? Unsecured funds might be like putting your down payment on a credit card. You actually can't do that. They won't allow you to do that. So we need it to come from your checking, your savings. You can borrow against or pull out of your retirement accounts, and sometimes check with your 401k administrator. If you're using it for the purpose of buying your first home, you can avoid paying penalties and taxes on that. So have a conversation about that if that's a strategy you're looking to use. You can also receive a gift from a family member, a close friend, or even your employer, but we do have to paper trail that. So we have to show that that party, that interested party that gifted you that money, had the money available to gift, and then we have to show it coming out of their account and into yours. So it's a little bit of a paper trail process, but it's really an extraordinary way to help you get into your home. So if you have a family member that wants to gift you money, let them. So let's talk about income. Income is really important because that proves and shows your ability to repay the loan that you're asking to qualify for and be approved for. So income comes in all different forms, right? So if you're a W-2 wage earner, you collect a paycheck, you show that income. Really, really easy. Typically, we request 2 years of W-2s, we request 30 days of pay stubs, and we just have to show that year-to-date matches what we're putting in for the application amount in which you are qualifying for. If you are 1099, or if you receive bonus income, commission income, tips, those kinds of things, we really have to demonstrate 2 years of receipt of that because we'll average it out over time. And if it's less than 2 years, some programs won't let us use that income at all because we haven't had that full history to be able to prove an average over time. I know it's terrible. Let's say you're self-employed, so you own your own business. We have to have 2 years of tax returns, and we base it off of the income that you're showing as your taxable amount. So if you made $100,000 in your business, but then you showed $80,000 worth of write-offs and expenses to operate your business, so you're only showing an income of $20,000 to hedge your tax liabilities to the IRS, unfortunately, we're only going to be able to use, in most cases, that $20,000 in income. Now, there are some other programs that we can use, kind of some one-offs, where we can average bank account deposits and those kinds of things, but it typically requires a larger down payment and really excellent credit history. So if you're looking at buying your first home, that's probably not going to be the way to go. So if you are a business owner, try to show as much income as possible. I realize you're going to be paying more in taxes that way, but that's the amount that we'll be able to qualify you on. So let's say you have a main job, but now you have a second job too. If you have not had 2 years worth of history of having a second job, not necessarily the job you're in right now, but a second job, then we can't use that as far as income for qualification purposes. Now, if you're just doing this side hustle or the second job, like I did, to have money down to be able to buy your home, that's perfectly acceptable. That's just fine. We'll put that on the loan application, but just know we may not be able to use that income unless you can show 2 years of having that part-time job in addition to having your full-time job. I hope I didn't just confuse you there. So let's say you have just a whole bunch of side hustles and you're just kind of making your way through this world. You're not necessarily employed by somebody. It's not really your own business, those kinds of things. We do have to show 2 years worth in that same industry. So that could get a little bit sticky if you don't have that kind of history. So you might have to continue working in those roles for 2 full years in order to show it so we can average it properly. Now, if you've had more than 3 jobs in the last 2 years, that could reflect as job instability and could make the underwriters a little bit uneasy. If that's the case, FHA has a guideline that requires you to be in your current job for 6 months prior to being able to close on that loan. So if you are looking to get approved and buy a home, work on being really stable in your employment and stay there. And if you're considering changing your job, if you've got months and months until you're looking to buy a home, get that change going now. Try not to do that change while you're in the midst of qualifying for a loan. Underwriters hate that. So just want to throw that in there. Another thing that's really important is if you just got out of school, whether it's high school, college, specific training, like a trade school or nursing school, something like that, that time in your education can qualify and satisfy that 2-year work history. So just so you know, we go 2 years back and we look at it. Now, if you just got a raise or a promotion or something like that, we don't average the income over the last 2 years. We're going to base it off of your salary or your hourly that you're getting paid now, not caring too much about what you've earned in the past. So that was recently a question that somebody came to me and said, well, I just got a promotion, it's significant, I'm making a ton more money now. We can use that income as your current income to qualify for the mortgage. So speaking of qualifying, let's get into that. What does that look like? There's actually two ratios that we're looking at: your housing ratio and your total debt to income ratio. Your housing ratio is the carrying cost of the home divided into your gross income. So before deductions, if you're a W-2 wage earner, so your hourly or salary. So let's say that your gross income is $36,000 a year, that's $3,000 a month. We really want your housing payment to be somewhere around $1,000 in a perfect world. Now there's exceptions to every rule and we can go higher, but just sharing with you the rule of thumb. Now let's talk about the total debt to income ratio. That's going to include that housing ratio I just spoke of, and then anything else that's going to report on your credit. So what reports? Your student loans, your auto loan, and your minimum credit card payments are all going to be examples of what reports. If you have a personal loan or something like that, that's also going to report if it's through like a bank or a lender. If it's a loan with mom and dad, you're supposed to disclose it, just so you know, but if it doesn't show up on your credit report, typically it's not mixed into your total debt to income ratio. Now, depending on the loan program, some will allow higher than others, but a good rule of thumb using the conventional amount for a conventional loan, a good rule of thumb for the total debt to income ratio is 45%. So in other words, we don't want your housing payment and your other debts that you're obligated to pay every month to exceed 45% of your gross income. The reason being is those equations have proven to make it the safest as possible, so that way you still have money left over for your utilities, your cell phone bill, your food, and some fun in your life. We don't want you to be house rich and cash poor. So this is where I've got to talk about student loans, because there's 47 million people walking around with student loans right now, and the average size of that student loan is $38,000. If you are currently in deferment or forbearance on those student loans, depending on the loan type that we go with, we either have to hold 0.5% of that amount outstanding or 1% against you if you are currently in a forbearance or a deferment. So if you have that $38,000 student loan, we would have to hold $380 as a pretend payment for that student loan against you in the qualification purposes. This is where I would say get onto an IBR, an income-based repayment, with your student loan servicer and try to make that as low as possible. So if they say for this $38,000 loan that you can repay it at $38 a month, we can use that on a conventional mortgage. On an FHA, we would still have to use that 1% against you. So again, depending on where you fall in and what your specific requirements are, might dictate which loan program we wind up going with. Let's talk about minimum credit scores. A great place to land is a 620 for a minimum credit score. The higher your credit score, really the better the terms for you, which means the lower the interest rate. So if you are at that lower spectrum on the credit scores, you're likely going to pay a risk-based pricing, which really indicates a higher interest rate. If you're paying a higher interest rate, that means more money is going towards your interest portion of your payment, which means that can affect the price point in which your home that you qualify for falls in. So we want your credit to be as spectacular as possible. So let's talk about what can kill a deal. You might be too high on your debt to income ratio, especially when there's student loans involved. So get really deep with your loan officer about that. If you quit your job, if you change jobs, if your hours get cut, something along those lines can be a deal killer as well. The inspections on the property might have you not moving forward with that purchase if that seller is not willing to make some corrections, repairs, or renovations to the home to remedy those things that your home inspector finds it's wrong with the home that you've chosen. And the other deal killer that I see is the appraised value. So once you do go into contract, we're going to hire an appraiser, which is a professional. It's going to tell us what the property is worth based on comparable homes in that area that have sold in the last 6 months. And right now in this current market, the last 6 months history is not equating to what people are willing to pay for a home, because there's less homes than there are buyers, so it makes it a seller's market. So people are willing to pay a little bit higher than the list price or the asking price, but the appraisal may come in lower than that. And if you don't have that difference to make up between the appraised value and your contract price, and the seller's not willing to come down, then it might kill the deal there. And a lot of people compare the process in their minds initially to buying a car. So you shop online, you find the perfect car, you go there, you test drive it, you walk into the finance office and you say, this is where I want my payment to be, go ahead and pull my credit, and then you figure it out from there. This is the exact opposite. You want to start with a pre-approval before you go out shopping for a home. First off, I don't want you falling in love with a home that you don't qualify for. And like we discussed earlier with those income situations, you may not qualify on paper if we're not able to use your full income based on what you're showing on your taxes. So if that's the case, you're going to fall in love with a home that you can't actually get financing for. And then if you wind up in a lower price point, you're constantly going to be comparing the homes that you're able to qualify for to the home that you fell in love with, and then nothing is going to meet that standard, right? And then you're just going to get frustrated. The other part is when you go to make an offer, you have to prove to the listing agent and to the seller that you are qualified to get the financing for that purchase price. So a lot of times you have to show a pre-approval letter, and a lot of times the lender has to talk to that listing agent to let them know that you do qualify for that home. So really important. Otherwise, you start that process only to find out you can't qualify for that home, and then you've wasted everybody's time. It's really important to the seller and the listing agent that they prove by accepting your offer, you are approved for that home. So I've created another video on what the entire process feels like, and I'd love for you to join me there so we can talk about that pre-qualification process, all of those milestones that you'll celebrate with all of those people in your lives as you go through the process of the home buying experience and the approval process, all the way to your clear to close celebration and closing day. So I hope that you visit me on the next video to talk about what that process looks like. Thanks for being here with me.